Reaching $1 million net worth is a huge milestone for any business owner. But what if that milestone is dangerously misleading? It can create a false sense of security. And the reality is, even if you continue on the path of saving $100,000 a year, you're looking at another 28 years of grinding to reach real financial independence. My guest today is Nick Maggiulli, who has studied this exact problem. He's an expert who uses data to show why your next financial moves are more important than your last. So don't go anywhere, because he's about to give you a new roadmap for the journey from 1 million to 10 million and beyond. And it's probably not what you think. Hey, Nick, welcome.
Thanks for having me on. Appreciate it.
Yeah, I've been looking forward to this conversation. And this is a different conversation in the sense that the Consulting Success podcast, we tend to interview and focus on successful consulting business owners or those that are working up the ranks to really grow their businesses. But you're not a consultant. You're an author. You are an expert in the world of finance. But the reason I want to have you on is because you've written several books on the topic of investments, around wealth, and understanding finances. And as we'll get a lot more into, you don't just share your opinions or perspectives kind of only from what you see, you back it up with data. And that's what always stood out to me as I've read your work. And I thought it'd be important to have you on and to get your thoughts and what you're seeing in the environment and what you've observed with others, professionals who are working to build businesses or to grow their wealth. Because the fact is, most people get into consulting or get into, I'd say, almost any business because they're after freedom. And whether they say it's related to income or not, I think we can all agree that there is an element of freedom that is in direct connection to having the money to enjoy that freedom or to create that level of freedom. So, with all that being said, let's start by talking about the wealth ladder. You have this concept. You've done a bunch of work on the wealth ladder as a roadmap for building net worth. Can you tell us and just explain what is the wealth ladder? And then for a consultant and a consulting business owner, how might they think about that framework in terms of being a high income earner or becoming one or growing their wealth?
Yeah. So the wealth ladder is a new framework that basically says that you need to change your financial strategy over time as you build wealth, how you make income decisions, how you make investment decisions, how you make spending decisions can change. For this podcast, we'll focus mostly on the income and investment decisions. I think for the most part, we can talk spending, but that's more like we're getting personal finance now. But in terms of for your audience, it's just saying like, hey, the things you used to do for money at one point may not be the things you're going to do later. And so some of your listeners here they've already done this transition naturally. Like when you first start a business, you're doing everything. And then at some point you're like, okay, I'm going to hire someone to do that so I can buy back some of my time, and you start kind of slowly growing the business. You start kind of, moving certain things off your plate, and you're doing that naturally in a business. I'm saying that same logic applies to your wealth and how you think about all sorts of things in your life. And so just take that logic of like, at some point, I shouldn't be doing this thing anymore. Well, just like, there's certain, clients you maybe would have taken on when you were smaller. And as you get bigger, you're like, actually, this is not as profitable or is not really the best use of my time. And so it's thinking about that within your personal finances, but it can be applied to many things, right? And so the analogy I give in the intro is like, just like a fitness instructor would give different advice to a morbidly obese person versus a well-trained athlete. The same thing is true of your financial advice. And that's what the wealth ladder is trying to do, is saying, hey, you're on one of these wealth levels. There are 6 wealth levels on the ladder. I mean, I call them levels, not rungs, because I think rungs just doesn't sound as good. So it's all marketing stuff, and I can talk through those levels and then we can get into that. So level 1 is less than $10,000 in net worth. And I use household net worth because that's what all the data is. So level 1 is less than $10,000. That's about 20% of US households. Level 2 is $10,000 to $100,000. That's also about 20% of US households. Level 3 is $100,000 to $1 million in wealth. That's about 40% of US households. Level 4 is $1 million to $10 million in wealth. That's about 18% of US households. And then the top 2% is 10 million to 100 million, and then 100 million plus. And 100 million plus has like 11,000 individuals in 2025. That's what the latest data shows. So there's not that many people in there. And so I kind of put level 4 and 5, 5 and 6 together because it's just such a small percentage of the population. But that's just a high level. I wanted to come up with a framework that was useful. And I know it's arbitrary, like why stop it? Why do a log 10 scale? Because it's easy to memorize and it makes it very useful. But then the data does actually fit it quite well, like 20%, 20%, 40, and then like almost another 20 in the last bucket, basically. So that's kind of my way of thinking about it. And that's kind of how I frame thinking about wealth and how you're going to think about how the decisions will change over time.
Why is that important? Like, I understand the latter. And it's surprising to me to hear that we have about 40%, or there's about 40% in the US, I think you mentioned, that are less than $100,000 in net worth, right? So we're not talking about income, we're talking about net worth, right? I mean, that shows there's a really big inequality or a gap in the equality there. But why would it be helpful for someone to understand that there are different levels, and how should they frame their decisions differently, or what should they be thinking about? So let's just take the example of somebody who maybe has $1 million net worth today, but they're looking at where they want to get to, and they know that they want to reach 5 million or 10 million in net worth. What would change? Like, of course they need to make more money, of course they need to save or invest. Beyond that, what have you seen is important, or kind of like where would the light bulb go off for somebody to think about things a little bit differently?
Yeah. So let's use the example of someone with a $1 million net worth and they want to get to 10 million. So if you're a typical wage earner, you have a 9-to-5 job. So I'm not talking about business owners, just real quick. We'll come back to like consulting owners in a second. But let's say you're a wage earner, 9-to-5 job. If you hit $1 million and you want to get to 10 million, let's say you save $100,000 a year after tax, by the way. So that's a considerable sum of money. And your wealth's growing at 5% a year. We'll say inflation adjusted just to make the math easy. Even if you start with $1 million, save 100K a year, 5% a year, how long does it take you to get to 10 million? The answer is 28 years. It takes almost 3 decades. And this is, once again, this is 28 years after you got to $1 million, which is not easy. No one just wakes up with $1 million, right? So to get to $1 million probably took you a decade or two, right? So after getting to $1 million, you have to do another 28 years of this before you get to, 10 million. So when you think about that, you're like, wow, that's a long time of grinding and saving 100K a year. Like, this is like, saving 100K is not easy to do, right? You're like, well, Nick, I'm going to really make really high income. I'm going to save 300K a year. Even if you're saving 300K a year, start with $1 million, 5%, it takes you 17 years to get to 10 million. So to get to that level of wealth, it's very difficult to do that through a traditional salary job, even if you have very high income, right? So most of the people that get past 10 million, besides like celebrities, athletes, entertainers, besides those people, most of those people are going to be business owners because they're having an exit of some sort that kind of propels them past 10 million or gets them even deep into level 4 many times, right? So, and you're saying, well, I know doctors. Well, yeah, a lot of doctors have their own practices, or lawyers have their own practices, et cetera. And so that's exactly kind of the thinking here. And so I have a chart in the book, and this is in the 3rd chapter, which talks about, well, what percentage by each wealth level, what percentage of their assets are in which asset classes. And so I don't know if this is showing right now, but basically,
I just put it up on the screen. I thought it would be relevant to what you're saying because, let's just talk. You could kind of keep on that train of thought and explain what we're looking at on the screen right now. And also, some people will just be listening to this only in audio. So let's try and make fill in the blanks for them so they have an idea of what's going on.
Yeah. So this chart shows by wealth level across the x-axis, what is the percentage of assets in what's called business interests. This means like your own kind of private business that you own. This is not stock ownership. This is not money in your retirement account. This is not your home or any side real estate. This is business interests, right? And so if you look, levels 1 to level 3 have like less than 5% or less in a business. Level 4 has somewhere about less than 10%. Those in level 5 end up having something like, almost 30%. And by the way, just a quick aside, to memorize the levels, like just remember level 3 is 100,000 to 1 million. And then you can, to go up a level, multiply by 10, to go down, divide by 10. It just makes it easier so you can memorize it. So once again, level 4, 1 to 10 million, they have about 10% of their assets in a business. But those in level 5 and 6, level 5 is 30% of their assets. And by the time you're in level 6, over half of your assets, so you're over 100 million plus, those people, in general have over half of their assets in some sort of businesses, an individual business or a set of businesses, right? So you can imagine Elon Musk, he has probably 99% of his net worth in different businesses, right, combined. So it goes to show, and by the way, I have many other charts that show kind of how wealth is distributed and how it's invested, across every wealth level. And what it shows is, in general, those higher on the wealth ladder own more income producing assets, things like businesses, stocks, real estate, money in retirement accounts, etc. And so you can really see that in the data. But in this particular instance, you can see like, how do people generate a lot of wealth? They have a lot of, they own businesses. Now, does that mean that every person that owns a business is going to make it to level 5? No, because obviously there's a high failure rate as well. So people know that. I mean, your listeners obviously know that, but it goes to show if there is a chance for most people, it's going to be through entrepreneurship of some sort, which in this case, it's consultants. And for the record, I don't know if you know this, I actually did work in consulting for the first 6 years of my career, and I've billed over 10,000 hours, so I can say I'm an expert at consulting. It was litigation consulting. I didn't have my own business. I was a analyst and senior analyst, etc. But I was I billed over 10,000 hours, so I know what it's like to work in a consulting firm. I've read Managing the Professional Services Firm by David Maister. I think that's the Bible of if you want to run a consulting business. I'm not as well versed as everyone, but I read this thing and I'm like, this is great. So that's the book I recommend if anyone asks me about consulting.
There we go. So if I was just to summarize what you're sharing here, is that if someone really wants to grow their net worth and their wealth, doing that just as a 9-to-5 job, unless you have a whole bunch of stock, in a rapidly growing, company, really, it's a key way to grow your wealth is through a business, and it's also by accumulating assets over time. And I think, like, what I always say to clients when I talk about their business and how to think about investing in their business is that my belief is that investing in your business is actually the best investment that you can make. Now, I don't know if from the wealth management side of things, you view that a little bit differently. When I say that because, one, you can control a lot more in your business than you can, in any other investments that you make. You put money into the stock market, whatever it might be, right? You can't control that. You're historically, right, it goes up, which is great, and why I and so many other people do invest into equities and so forth. But the ability to invest in a business, it's amazing what that can do, because the value of, let's say, landing one new client or multiple new clients is really so significant compared to what you might put in. And I think this graph here, or this kind of chart, really helps to see that if you want to grow your wealth, you need to be thinking about investing into your business, or having a business, or growing a business. Is that kind of an accurate summary of what you've seen?
Yeah, no, I completely agree with what you're saying. Obviously, there is risk considerations to discuss here, but for outside of that, you're right. You do have more control over this thing, and if you want a chance of building really great wealth, I think you have to be a business owner, and that's just what the data shows. And of course, like, well, what if someone's an athlete or something? Like, besides that rare, very very small percentage of people, like I always like to look at base rates, and that all that means a base rate is like, what is the typical person in this role? Like, how does their life turn out, right? So if it's like, okay, like most people that try to be athletes don't end up making it. Most people that try to make big businesses don't make it either. But I think the success rate is much higher for business owners than trying to make it to, like, say, the NFL or the NBA or something, right? And so because of that, it's like the base rate's higher. So assuming you can actually go out there and try there and get to a certain point with your business, you're probably more likely to succeed in that endeavor than all the other endeavors that got people to, let's say, level 5 in it.
What's the most common mistake that you see people making when they're trying to climb, the different wealth ladders, or when they're moving from one stage to the next? What kind of comes up often as a mistake? Or
this is the kind of the premise of the book. It really depends where you start. I think people in level 1, the mistake they're making is they're probably not getting to a sense of safety. They need to build that safety. And if the longer they wait and delay getting that safety, the higher the probability of them getting into kind of an endless cycle of debt and, possible bankruptcy. And they just can never get ahead, right? You can imagine a scenario where even something is, for most people, like, oh, a flat tire, oh, that sucks. Like, for someone in level 3 or level 4, okay, you just go get it repaired and you move on with your life. For someone in level 1, they could end up not getting to work, they lose their job. Like, you can just imagine kind of the chain reaction that happens that just changes the course of their life over something as simple as a flat tire, right? Which should not change the course of your life whatsoever, right? So I think it's something to think about. But yeah, it's really just like, where do we start then determines like kind of what are the types of things to look out for, right? And so I think if you're, let's say most of your audience is level 3, level 4, are going to be level 3, level 4 after they, they exit their business, et cetera. the types of things there is like, how are you investing that money? And so like, obviously there's risk, which I've already talked about, but let's say you do sell your business right now, you left the business, maybe you got 50% cash, maybe you have an earnout, maybe you got all cash, whatever. What do you do with that money after now? Because that's, you had this big success, you got out of it now, but now what do you do with that money after, and how do you invest that money? Because that decision, if you're not really familiar with investing because you put all your money into your business, now the question is like, you're kind of in uncharted territory. You have like your whole life savings, basically, and you need to invest that. How do you do that? And so do you end up hiring a financial advisor? Do you go at it alone and hope, you can deal with any sort of volatility that you wouldn't have necessarily experienced in your business? So I think it's those are the types of questions I would think through in this.
I just pull up on the screen the 1% rule that you have as well in the book. I don't know if this is the right time to speak on that. I do want to come back to what you were just talking about in terms of as people increase their disposable income or their overall wealth, how to start kind of evaluating that in terms of decisions for the future of their business or their career. But is there anything you want to say about the 1% rule? Because I think that this obviously is directly connected to the levels. Do you want to just make any comments on this?
Yeah. So the idea behind the 1% rule is you take your net worth and then you just multiply by 1%. You take 1% of it, right? Divide by 100. And whatever that number is, that's like a proxy for like a limit of what you should consider for future income opportunities. So for example, if you're like, oh, should I bring on this new client? The idea is like, what's the lifetime customer value of that client? And if that number is below the 1% rule, then you really need to be like, do I really want to bring this client on? Is it worth it for this type of thing? Or even, it may not even be a lifetime customer value. You can just say like, okay, what's the fees I'm going to charge on this client or through the end of this project, right? So if you're in level 4 and like, oh, this client will get me $1,000 in total and it's going to take however many hours it's going to take, right? It's like, of course there's a time element here, if I'm being honest, like time matters, but like all else equal, it's like, if I'm in level 4, like I probably, if someone's only going to pay me $1,000, I'm like, that's not going to really move the needle for me, right? Especially if I'm like, let's say you have $5 million, $1,000 in extra revenue is useless. You need to have, 10,000, 50. You need to really start getting bigger clients that can move the needle, right?
Hey, Nick, so just to jump in for a moment here, just to clarify, because I think this is actually a really powerful framework for people, because as you become more successful, you start to have more options. And I think it becomes more important to get comfortable with saying no than just saying yes, right? In the early days, you kind of by default and definition, you're going to say yes to a lot more things because you don't know yet what's going to work. And you also just need more swings at bat, right? More chances of kind of, hitting that home run, if you will, or at least getting to first or second or third base. But what you're saying here, so let's say level 3, somebody whose net worth is between $100,000 and $1 million, for them, if you're thinking about, should I take on a project? If it delivers between $1,000 to $10,000 in value, it might be worthwhile for you to take on. So let's say you get offered something, a speaking opportunity, and they're going to pay you $5,000 at a local association. Well, that might be worth it, right? And then not to mention the follow-on opportunities of additional leads you might generate there. But let's say if you're at level 4 and someone says, hey, can you come and give this talk? Or somebody wants to work with you, but they're only able to pay $2,000, but you're at level 4, meaning that your net worth is between 1 million to 10 million. Is it worthwhile from a financial perspective to say yes to somebody that's going to pay you $2,000? And this framework says, well, generally you'd want to think about that 1%. So that's between $10,000 and $100,000 in value. So this is really could be very helpful in evaluating what to say yes to and what to say no to. Are there any applications or examples of how you've seen kind of people bring this into their real lives or in their profession?
Yeah, I think you hit the nail on the head here. This really is, it's not perfect. It's just it's another tool in your toolkit, right? Because like, let's say you love speaking. You're like, oh, $2,000. Yeah, I'll take it. I love speaking. I don't care. I just love doing it, right? Or maybe I'm only get paid $2,000 now, but I know I'm going to get maybe 3 to 5 clients and that's going to bring more. And so it's not just, you can't just use a number, but like, it's just another thing there. You can say like, well, yeah, actually $2,000 is not enough, right? So there's a lot of other things to evaluate, but I think the point of this rule is it's just another tool in your toolkit, to another evaluation method when you're thinking about income opportunities, bringing on clients, like the types of clients you want to bring on, like how you use your time. And so I've tried to come up with something that gets at that. And this is exactly how I've used this thing, right? And so I'm using this now where like, I will, I try not to do speaking things below a certain amount, below, 1% of my net worth. I'm like, it's not going to really move the needle. Now, of course, if it's really easy or it's like a friend or something, I might just do them a favor for something cheaper or whatever. Like that's not a big deal. But there are obviously exceptions to this rule, but it helps you realize like, hey, I used to do that for money and I don't do that stuff for money anymore, right? And this is true of anyone building a consulting business, because at some point you're going to want to hire other consultants, right? Obviously, you're going to hire more. That's the whole point of the business, right? And they're going to be the ones serving clients, and you're the one managing the team or doing other things when you're running the business. And so thinking about that and how you structure that, this is exactly like, oh, I don't do that work anymore. I can hire someone to do that. And I do this other work, which is higher value. And so that's the premise. It's built into the wealth ladder. And there's a natural progression as your wealth goes up.
Have you built a consulting business only to find yourself feeling stuck? Are you tired of relying on referrals, struggling to bring in new clients while serving the ones you already have, and knowing you need to raise your fees but feeling overworked and spinning in circles under a revenue ceiling? The problem isn't your expertise, it's clarity. And that's why we created Clarity 2.0, our newly upgraded coaching experience. Powered by our ROI verified growth system, Clarity 2.0 is designed for one thing: real results. With coaching personalized to you and your business, proven consulting frameworks, intelligent AI-powered tools that accelerate your learning and amplify your results, and a curated global peer community, you'll finally gain the clarity, confidence, and control to take your business to the next level. And the numbers speak for themselves. Over 80% of our clients raise their fees, refine their niche, or reposition within 90 days. Many double their revenue in under a year. More than 1,000 consultants across 75 plus countries, from solo specialists to multi-seven-figure boutique firm owners, have transformed their businesses through our methodology. And now it's your turn. Head over to consultingsuccess.com/grow and book your growth session call today. It's time to stop grinding and reacting and start intentionally leading your next level of business growth with Clarity 2.0. Right. That makes a lot of sense. All right. So I'm going to stop sharing that for a moment. You brought up before we just talked about the 1% rule, the situation of someone who, let's say, has been building a successful business. They're generating good income from that business. And then they start wondering, should I sell this business? If they sell the business, however, in most cases, they're going to have a bunch of tax that they're going to owe. Then they need to do something with the money that they have left over from after paying taxes from that business. What have you seen, and kind of how do you, counsel, or what would you suggest that people think through when they're deciding between, hey, I have something that is working right now, but maybe they've lost some of the passion or the interest, or maybe they're just thinking this could be an opportune time to sell this business. But if they're not clear on what they actually want to do next, what are the factors that you think people should consider, or if there's a framework that you find helpful in kind of evaluating the future of whether to keep building a business or whether to sell a business? What have you seen there? How do you think through that?
Yeah, there's a lot of factors to consider. Let's just start with the financial ones briefly, and then we'll get into kind of the psychological ones, which I think are equally, if not more important. The financial one, don't be a forced seller. If you're like, oh, I have to sell my business now, that's the worst thing you can do, because it's going to come across in how you talk to people. That desperation, people are going to realize that, and the best time to sell your business is when you don't need to sell it. That's really the truth. Like if you can say, hey, so like, I'm not ready to sell. Go out there and just start talking to people. Just see like, what's the market like? Go through the process. Understand how you feel when people give you an offer. Like go through that even when you have no intention of selling, because that's going to get you used to it. You're going to have contacts. You're going to have people you can contact in the future. And then maybe one day you call them up again, and say, hey, I'm actually thinking about selling this time. And but then they might say, oh, well, now I'm going to, discount it or something. So you have to think about how you go through this process. And I think the best time to sell your business is when you don't need to. Because if you need to be a forced seller, it's just the worst thing that could happen. You don't want to be like, oh, well, business dried up. Now I want to sell my business. Like, no, it's the worst thing you can do. So that's the thing I would say on the financial side. In terms of the psychological things, like, yeah, you have to think about think about your life that you want and then back out from there. So like, hey, I want a life where I can do X, Y, and Z. It's like, okay, can you do that while owning a business or having a minority share in the business? Or can you do that maybe after selling the business and then investing it? And obviously you have to do a little bit of research on understanding how much income you could generate once you've sold the business for a reasonable amount and reinvested that in a diversified portfolio, et cetera. But that's kind of the issues you're thinking about. I always say like solve backwards, find like, okay, here's my idealized life and here's kind of how I imagine it happening. Okay, let's move backward from that on how much money I might need, etc., for to grant me that freedom. And then let's see, what do I need to sell my business for? And then how would I allocate that money afterwards to get to that lifestyle?
What I've observed with many clients over the years who have, grown their businesses to pretty considerable levels beyond where they maybe even initially thought they would be able to reach, is that the things that they are thinking they would like to do in the future when they sell the business or when they get to that next level, very often they can actually do them much sooner than they think, right? And it's just figuring out, well, what needs to change, or do you need to delegate better? Do you have to have better systems? Maybe you just need to go for it and see what happens. But this idea of putting things off. So I like what you're saying, for people to get very clear about, what does that meaningful life look like for you? What does success ultimately look like? What are the things you want to do? And then just explore, are there ways to do them sooner? Or what would things be like in terms of, if you didn't have the business in the future? So another thing that kind of brings up for me, Nick, for consultants who are thinking about their finances, the business is growing, maybe they're making more money, but as their business grows, they might also start seeing their profit margin as a percentage decreasing because maybe they're adding more team members or they have more expenses. But if someone's wondering, like, am I on the right path? Like, am I going the right direction? How would you suggest that they think through that? What should they be considering? What should they be looking at to just know, like, am I directionally going the right way, or how can they potentially catch themselves from making bigger mistakes or taking the wrong path and later learning that they could have done something differently?
I think you have to benchmark. And so this is one of those things where I'm not an expert in terms of consulting businesses and sizing and profit margins, et cetera. It's like, what does it look like as you transition from one type of firm to another? And I do have some experience in this. I'm the COO of Ritholtz Wealth Management. So I have some experience on this on the wealth management side. So I have an idea of, okay, here's what happens to margins as you grow, or as if you're growing very quickly. Let's, for example, we have a media arm. So we have, I think it's 5 or 6 employees now that we hire on the media side. And we do have some revenue coming in from the media stuff, but the RIA, the actual financial firm, subsidizes that because that's our growth engine. That's how we've grown so much. So that's a very weird thing. If we didn't have the media arm, we would have better margins, right? So you always have to control for like your specific situation, how you market your business, et cetera. But I think the thing to think about is like, what tends to happen as these firms get bigger? Like, just really do the research, go out there. If you have to pay for data on this stuff, do it, because it can be very worth it in terms of like understanding, like it's a business expense as well. You can understand like, what does that transition look like and what should I expect to see? And is my business reflecting that? And if it isn't, is there a reason why? And is there something I can adjust for? Because sometimes it's like, oh, I have a much bigger marketing engine, so of course my margins are lower. And that's fine. If you have a higher growth rate than average, maybe that trade-off's worth it. And you have to think about those types.
And what about from a wealth kind of management or just wealth building perspective? Are there certain things that, or is even data that would support, like if somebody, looked at that, they'd be able to say, yes, okay, based on that, I think I'm doing the right things. Like I'm saving 10% of my monthly income, or my investments on average are going up by this amount. Like, are there any, I guess, principles or data points that you would encourage people to think about or to get comfortable with that would help them to know whether they're going in the right direction in terms of building their wealth?
Yeah. So I think, once again, going back to finding benchmark and comparable data. So in terms of actual wealth, in the book, The Wealth Ladder, I walk through a lot of this stuff. So in chapter 2, I talk about income. So for example, let me get the actual page number here in the book. This is in the second chapter, which is earning up the wealth ladder. Give me 1 second here. So on page 25, there's a table which shows the median U.S. household income within each wealth level. And so, for example, level 3, the median income is about $83,000 a year. In level 4, the median income is about $200,000 a year. In level 5, which is 10 million to 100 million, the median income is about $724,000 a year, right? So I'm just covering those. That's going to cover basically everyone listening to this. So if you're saying like, well, am I on the right track? Like, is your income from your business kind of in that range? And if you're like, oh yeah, I'm making over 200K a year, great. Then you're on the path to get toward level 4, right? Even whether you sell your business or you just keep earning the income.
You said 200K per year in income. That's
the household
average for the householding of
median
average of people at level 3.
No, 200 is level 4. That's
Level
1 to 10
4.
million. Yeah.
And I thought you said 400,000 and 700,000.
No, so I apologize. It was 83,000 in level 3, which is 100,000 to $1,000,000 in net worth. It was around 200,000. It's 196. I just say 200 for rounding. It's around 200,000 for level 4, which is 1 to 10 million, and then level 5, which is 10 to 100 million, is $724,000 a year. So if you took all the people in level 4 and you put all their incomes and you took the middle income, it's roughly 200,000. So if you're making more than that, you're doing well, and that's great, and you just need more time. So a lot of this thing too, which I talk about this in the book, and in the 10th chapter, is all about mobility. Like, how long does it take to climb the wealth ladder? Like, I look at these snapshots, etc. I follow the same households over time. And the thing is, age is a big thing here. Like, there's a lot of people that are in level 2 right now, but they're young, they're in their 20s, and like they just started. And it's like, it's not because they've done anything wrong. They just need time. They need a few decades to get into level 3, level 4, etc. But in terms of, am I on the right track? How's your income tracking relative to other households, right? Look at that. And then in addition to that, I have in chapter 10, there's actually data that shows, are you in your 30s, 40s, 50s, et cetera? And it says what wealth level, where the distribution of wealth is, right? So for example, less than 1% of households in level 4, 1 to 10 million, are in their 20s. It's very low. And it's only 5% in their 30s, and it's about 15% of those in their 40s. So it's a small percentage. It goes up from there. The median age in level 4 is actually 62. So if you took all the people in 1 to 10 million, put them in a room, 62 is the middle age, basically. So just something to think about. And so that's some good wealth benchmarking data. If you could, I don't have this data for consulting firms, but if there was a wealth ladder for consulting firms, that's the type of stuff you want to benchmark. It's like, what's the size of my business? How is it comparable? How's my, revenue per employee, profit per employee? You know all these metrics, right? Go through all those things and see.
Yeah, I mean, you just brought up something that I think is incredibly, incredibly important, both for building wealth and also just for being successful in business, and probably also long-term fulfillment, which is time. Like time, doing what you're doing and being consistent. Of course, everyone wants to make more money as soon as possible, but the reality is, like, anytime someone has done, if anyone who's joining us right now has had a financial plan done, right, or kind of looked at some investment projections, right, it goes kind of like slowly increases, but then after enough time, right, that compounding like really kicks off, and you start to really go up into the right pretty considerably. But if people don't have patience, right, if they're kind of buying and selling too quickly, or they start and stop in their business and they're not consistent with it, it feels like the benefits of compounding, it's like you're not allowing that to happen. And so I think that's actually really important when we talk about building wealth, and just increasing your success in so many aspects of business and life. It's, you need to be committed to something and really put in the time, because that's where the good things start happening. But if you're not patient, and if you're not persistent and consistent, then you probably won't get the full value, or be able to climb that ladder, if you will, as much as you want. So I don't know if you have any thoughts on to add to that.
Yeah, I think a lot of this is just, it's outlasting other people because they're not willing to do it. Like, that's it. Like, I've been writing now online for almost 9 years. It'll be 9 years at the end of this year. And, I don't know many other bloggers that started when I was writing and still writing. And all the ones I do know are very successful because they've been doing it for so long. Maybe there's obviously they're still doing it because they've had some success, right? There's a piece of that as well. There's survivorship bias, obviously, but even controlling for that, it's like, I don't know many people that I'm like, oh my gosh, they were trying to write for 5 years and just nothing happened with it. Like, I literally don't know a single person that's done, and I'm saying there probably are people out there like that, but I don't know any of them, unfortunately. And so, like, I've never heard of them. They've never reached out to me and like, hey, I've been blogging for 5 years and it's never taken off. Like, I've never seen it. Like, so that's the thing, is like, this, it does take time. Like, for my first 3 years writing, I didn't make any money on that, right? I had my job and everything, but I didn't make any money doing that. And then, you start getting web ads, you start writing books, you start doing all these other things. And like, you can really see like the growth of that over time. It just takes time. And sometimes even when things don't look good, the next year you can have a really good year, and then, margins move up more than you thought. And now you're like, wow, this is actually very profitable.
So let me ask you, Nick, because this is actually a question I had down. So I'm glad that you're already bringing this up. If you think about the success that you've had in terms of the notoriety, the authority, the exposure, the career advancement, the wealth that you're building, how much of that do you trace back or connect to writing?
My My total, like if I had to do, I don't have any exact percentage. I'm trying to think of in terms of my first, but okay, I don't have like an exact percentage of like my total, but I would say it's maybe a little less than half. I would say actually no, let me think real quick. 1 second. Actually, so I actually do know this. So I apologize. I just need to think about it for a second. So roughly 25% of my net worth right now I can attribute to the profits I've generated from my business, and the other 75% has come from me working since 2012.
Right. Now, the work that you've done, like, do you think you would be in the role that you're in today as CEO of results management, wealth management, if you weren't writing?
I think it's I mean, I wouldn't be at Ritholtz, but I could still do that job without the writing. So to answer your question, yes. I mean, it wouldn't have been at Ritholtz because they found me through the writing. That's how I got my foot in the door and kind of did a lot more stuff. But like the work I do at Ritholtz has nothing to do with my writing. I obviously, we are a wealth management firm, so my book and stuff does help bring in some clients and stuff like that. That is a kind of ancillary benefit, but that is not the reason they hired me, right? They liked that I did that as well, and so it was a perfect fit where I'm a content creator. I'm also helping the business grow. And so, when I joined the firm, we had, under $1 billion, we had about $800 million in assets, and now we're at, 6.5 billion. So I've seen the firm, and this is since 2018, I've seen the firm go up, over 6x, which is kind of crazy, but it's been a wild ride to get there. And it's like just watching that growth and seeing like, and yeah, margins weren't as good early on, but like you'll see like things grow, things happen more. You got to just keep at it. Like everyone works so hard at the firm. The partners have done such a great job. And now, we have a large, profitable, doing very well firm. And so we've been very fortunate, but it just takes a long time, right? It takes a long time to get there.
So I guess, yeah. And the reason I was bringing this up is I'm thinking about your brand and what you're known for. And my sense, and definitely correct me if I'm wrong on this, is I would attribute a lot of that to the writing that you did, right, and that you still do today. And I guess what I was wondering is, how long did it take? I know you said it took 3 years for you to start making money from your writing, but how long did it take before you actually got to the point where you felt my writing is starting to work, and I think that this will create some success for me? It's like, kind of reaching that tipping point where you saw results, you saw a response, you knew that you're on the right path.
It was the end of my first year. I kind of knew that this could be a thing. Now, of course, I wasn't trying to monetize it though. And because I was looking at all the monetization schemes and they just didn't seem like enough money. So I'm like, not going to do this. Like, I don't want to spend all this time on something that just, wasn't going to generate enough income. I waited until my audience got big enough, so to speak. I had enough page views, etc., where I was like, okay, now it makes sense to turn the thing on, right? I didn't want to do it before, and I want to get to a sufficient size. And this happens all the time where someone has a freemium model and then maybe they start charging for stuff later, right? And so that's the same thing I did, where I was like, no, I'm giving this away for free. I just want to build my brand. I want to become a better writer. Like, I'm a much better writer today. Like, I read some of my old blog posts and I'm like, oh, I'm almost like want to rewrite sentences because like I wouldn't write like that today. So it's interesting to see that. Yeah.
Yeah. How often were you publishing? Like
once a week for almost 9 years now. So where I'm on post like 460 something,
right?
Maybe
so
almost 470.
You published every week, 4 times a month for about a year. And until that 12-month mark, give or take, you felt you weren't sure where this would lead. And I'm wondering, why did you keep going? Because so often, and just to connect this to the world of consulting, so often, like what you did is what I think a lot of consultants should be doing, which is leaning a lot more into content, finding a channel. It doesn't have to be writing. It can be videos. It can be podcasting. It can be whatever. But finding a channel where you can demonstrate your expertise, where you can share your opinions, right? Where you can essentially put your stake in the ground and say, I want to be known for this. But people try it. They jump on LinkedIn, right? They do blog posts. They do whatever. They give it a shot for a few weeks or a few months. They can't attribute growth in their business or any growth. They're not seeing the fruits of their labors, if you will. And then they stop and they say, it didn't work for me. I'm wondering, did you ever feel that way? And if so, what kept you going?
So that first year was definitely the hardest year because you don't know, right? There's that uncertainty. I had moments of like, oh, wow, like people really like this post. Great. Like went like, I don't want to say viral. Nothing I've done has gone that viral. So, but like there are little things where like I'd put something out and I'm like, oh, that got like 20 likes. That's incredible. That's an amazing thing. Like for me, that was like a ton of likes now. If I got 20 likes now on a post, that post does bad, less bad. Right. So all I'm saying is like, that's, that was happening. I'm like, okay, that's kind of cool. But like, you're going to have, and then I had moments of silence. I had moments of like 20. I'm like, that's enough to know I have something. Let me just keep going. So I had little moments of success, but nothing big. By the end of the first year, I got to meet a lot of people I looked up to in the space, and they're like, oh, I love what you're doing. And that gave me the confidence. Like, I'm going to keep going. Like, period. I don't care how long. I don't obsess over like, it's like I get a new shot on goal every week, right? And so I don't obsess like, oh, this week's blog post didn't do as well as last week's blog post. I don't care. I keep writing because I'm trying to put out good stuff. I'm trying to help people. I really am. I do love writing. I love doing this stuff. So that's what it's about for me. So like for those people like, yeah, I only did it for 3 weeks. I didn't see much results. Like you're not going to probably see much results in 3 weeks if I'm being honest, but you got to kind of love it too. So you got to find, if it's agony to do it, don't do it, right? You got to find the thing you naturally like to do. Find whatever content medium that is, try different things, and you're like, oh, this is actually not too hard, isn't it? Maybe it doesn't take as much time, or I really enjoy it, or it's a good pace. Just start that and just see where you can go with it and then give it time. But I think it's fine to give up on things. I think quitting is good sometimes. So it's okay to be like, oh, maybe content's not my thing. But hire someone that can do content and or find someone, maybe not doing that with the showing expertise, because then are they the face of the business or you? So maybe not that, but maybe they can help you do content. Who knows? Like think through how you might want to do that. There's just more options than you think. It's not just like, oh, you have to be a content creator. I don't think that's the only solution for business owners.
Yeah, no, I mean, it's a good point. If somebody doesn't enjoy writing, find a platform that you do enjoy, or let's say you're just good at talking, right? Record your audio, have somebody like get it transcribed, have somebody edit it and work on it, to get your content out. The main idea, or I say the main thing, is to get your ideas out there into the world and your opinions, so that people actually know what you stand for. You spend a lot of time looking at data and thinking about finances and thinking about wealth. What are one or two things that you kind of really continue to bring up? So when you're meeting somebody for the first time, or you're at an event, right, you're having a coffee, whatever, are there a couple of data points that you think would be really relevant for consultants to understand when it comes to money or wealth building? And maybe even from the perspective of the general consensus is A, but you know by looking at the data it's actually C or D is the key.
So I don't have that for consultants. I'd have to probably think
But
about
I mean, it doesn't have to be for consultants, but just like for a business owner in general.
Yeah.
Anything that kind of stands out for you.
I mean, for business owners in general, I would say like the main thing, like if you want to get to extreme wealth, you have to own a business. So that's kind of maybe obvious to a business owner at this point, but like most people like, oh, like how do they get there? Like if you just look at like the base rates, once again, it's going to be business owners. So that's the thing I think about. The other thing I focus a lot on income, because income is like the driving engine behind most wealth. That's like the most positively correlated thing in personal finance is income and wealth. Like it's very rare to have high wealth and low income, or or high income and low wealth. So one or the other, they're always paired together in general. Like the lowest wealth households with high income have more wealth than the highest income households, or the lowest income households with high wealth, right? So it's like very interesting. Like I have a matrix of this that makes more sense. I'm sorry if that's a little unclear, but basically like, they're correlated. Very, very much so. And because of that, like it's something to keep in mind. It's like, okay, I need to focus on building income. And so as a consultant, it's like, how do you grow? And you don't want to go overboard on growth either. You want to get to a spot where like, okay, you're feeling comfortable. And then the question is, once you get to a point where like, okay, I can build a lifestyle business off this, the next question is, and I think this is a bigger kind of philosophical discussion, is do I want to grow this so it's like it's massive and I have a big exit, or do I want to just keep this as a lifestyle business and keep my stress low and enjoy my life? And those are two very different questions. There's a great book I read recently called Company of One it's Paul Jarvis, where he talks about this. Yeah. So he talks about this a lot. And I think it's a great framework to think through. Like, okay, you need to get to a point where you can have the lifestyle business. But the next question is, do you want to keep growing and get to the point where you have a really big business and you can really generate a lot of wealth? But usually there's sacrifice needed.
Yeah, I think that's a really important topic, and one that I've been hearing from people a lot more recently, which is interesting because it's happening with people in slightly different industries. Not all one industry, is not only consulting, and it's with people at different company sizes who are just kind of rethinking what do they really want, right? Where if you would have asked them this question a couple of years ago, it was no, I want to build something really big. And now it's, well, do I really want to do that? Is that, is there a better way to go about this? And to me, what's most important about that is that there's no one way to do it, right? It's just understanding what are the different paths that are available. And then, as you said, what are the pros and cons of each in general, and what then lines up best for you as an individual, right? And what you really want, and then just becoming comfortable with that. So I was going to ask you as well. Right now, obviously, everyone's talking about AI. There's a lot of change uh, in the world with governments and wars. And I mean, just it's a very uncertain time or a time of rapid change. I think we could agree on. Does your approach or your just even your thinking about wealth building in this era of AI and rapid change, has it changed compared to maybe how you thought about wealth and investments and money? If I was to ask you this question, 5 years ago or even 2 or 3 years ago.
I think it has sector level impacts. And for what I mean by that, like, for example, if you're like, oh, I'm going to start a business where I train people to be, junior software developers. Like, that's not a business you want to be in right now because AI can replace that, right? So you don't want to go into maybe a training for like a junior level software developer, right? If you want to do okay, I'm going to train you to be a deep AI researcher, okay, and you have like a really high end, type of business, that might make sense. But the other one, doing like one-off sessions and stuff like that, I think that's changing a little bit. But to quick questions or quick things going back to what you said previously, I think if I had to kind of reframe like what's the big thing for business owners, and I thought about it a little bit more, you talk about like this, okay, people are asking like, what should I be doing now? Like, okay, should I keep growing? Do I even want that? I think this tends to happen in level 4. That's the 1 to 10 million range. And that's where people can get to their, something's called coast fire, where it's like, hey, I've saved up enough, or I have a business big enough that if I sell it, I can be okay. And I can kind of reach financial independence, or have enough money where I can just maybe just dabble on the side. I can maybe consult for consulting business owners and make just a little bit of income, enough to get me to retirement. So I think that is the big decision point for a lot of people. It's like, hey, I've gotten to a point where I need to decide, do I want to keep growing or do I want to take my foot off the gas? And so that is the thing I think about a lot for especially those that are getting kind of borderline into level 4 or deeper into level 4, because that's the kind of thinking there. But just wanted to put that as a quick aside. But
yeah, I mean, so let me ask you on that, because I think historically, if you do a financial plan, right, or the idea of you get to a certain net worth, right, or a certain amount of investments, and then you could look at, well, how many years do you have, right, based on your age, that you need that, and you take the, let's call it a 5% or 6% average annual return. You take 2.5% inflation, give or take. And you can then see like, well, how many years are you good for, right? And how much can you pull from your investments or from your business or personal accounts or whatever. Is there any danger or any change to that kind of framework or model, given that we're in a world now where there's a lot of talk about inflation increasing and about the dollar? So specifically, let's say the US dollar, although I'm in Canada and I think the Canadian dollar also has a very high likelihood of being devalued. So if the dollars that we earn in are decreasing in value and the inflation rate over the long term might increase, given that there's more money going to have to be injected into the system, debt levels across the world are increasing. Does that change how you think about people kind of going through their financial plans, and like, a danger of maybe stopping to work too early? Or is there any kind of conversations you've had or any thought that you've given to this in terms of the data and just your own kind of experience?
yeah, so inflation is destructive no matter how you look at it. And I think, the 2% inflation target is a great way, because it's better. A little bit of inflation is better than deflation. I think there's plenty of data to show that. So I think everyone's in agreement on there. But you're right, we don't want inflation to get too hot, because then that really distorts certain types of behaviors. It makes people kind of take even more risk, because it's like, hey, if I'm not going to save cash, I'm going to just invest it all the time. And so you can see valuations go up. Like, there's all sorts of like hyperinflation. I mean, I don't think hyperinflation is going to happen, but that is a risk that has happened in certain economies, like where their currency is just devalued very rapidly. So thinking through that, you're like, yeah, maybe some people might want to work a little bit longer, et cetera. There are ways to think through this. I think the 4% rule is just the simplest and easiest way to do this. And the guy who came up with that, Bill Bengen, he just came out with a new book where he's now basically promoting the 5% rule. He's like, the 4% rule, with the data we had then, if you include all the data through today, like, it looks like the 5% rule would have actually worked, basically, or he goes up to about 4.7%. So
and can you just explain that for everybody? So for those that aren't familiar.
So 4% rule, how the original research worked, and he did this in the early 90s, was you take your portfolio, let's say you have $1 million, you pull out 4% in the first year. So let's say $40,000, and that's your spending in the first year. And then you adjust that for inflation. So let's say at the end of the year, you go to the BLS site and it says, oh, $40,000 is now worth 44,000 or 42,000, whatever it is, right? Then the next year, you pull out 42,000, right? And you do that every year. And he did this for a 30-year period. And basically, if you had done it through any 30-year period in US history, and this is a 50-50 US stock bond portfolio. So you had half your money in stocks, half in bonds, and you pulled this money out of this account every year for 30 years and followed this system. After 30 years, you would have made it to the end without running out of money. And no matter when you started, whether you started right before the high inflation of the 70s, whether before rates peaked, before the great financial crisis, no matter what, you would have made it through your kind of retirement. Actually, not GFC, because technically we haven't had 30 years since then. But you get the point. Like through Great Depression, even this worked, right? So my point is that's what the data shows. And so now he's saying 4% was the old one. It was actually 4.15%. Now he says you can go up to 4.7 if you include like small cap stocks and a few other things in your portfolio. So he's basically almost arguing like 5% rule is like a 98% chance of success historically. And so he's arguing you can pull even more. I mean, just to be conservative, let's just stay with the 4% rule. If you are worried about inflation, you're worried about all these things. And this includes inflation adjustment. So if you're like, well, Nick, aren't we worried about inflation? Well, all the historical data included all these periods that had higher inflation. Now, if we're entering an inflationary regime that's unlike any before, like we're getting much higher inflation, obviously, we don't know because history can only do so much. But I'm not as worried about that for the long run. Obviously, it is a worry in the next few years, but how does it solve itself? I'm not sure, but I don't think necessarily I think the debt can go much higher before things really start to, unwind. Because look at Japan. Japan's not in the best scenario, but like their debt to GDP is much, much higher than the US, and they control their own currency as well. So it's just something else to think about.
So just to clarify that for everyone, you're saying it's not just taking the 4% rule of say $1 million, $40,000 per year. You're saying in year one, it would be 40,000, but year two, it would be 40,000 plus whatever the inflation rate is. So
Yep.
It might take out 42,500 if it was 2.5%. And then again, year three, you would look at if it's 2.5 again, you take out another 42,500. So it's just whatever the inflation rate is currently at that time. That's what you would take out above the 4%.
Yeah, so you take the 4% in year one. That is now an amount. That's just a fixed amount. After 1 year, if the inflation rate was, I'm just going to make the inflation rate just to make the math easy. Let's say the inflation rate was 10%. The next year you'd pull out 44,000 because 10% of 40 is 4,000, right? So the next year you pull out 44. If the inflation rate again is 10%, the next year you're pulling out 48,400 or something, right? Another 4,400 on top of the 44,000, right? So you just keep doing that, whatever. Obviously I'm not assuming we're having 10% inflation, but you get the point, right? You adjust it, and he did this. He adjusted it every single year for 30 years. And obviously, if there's deflation, you pull less, right? So that's, that did happen in the Great Depression, but once again, that's rare and it's not supposed to happen too often. So that's kind of, you do that, you follow the inflation rules, and you would have, it's called the safe max, or the highest, how much could you pull out across all periods and still not run out of money? And that's the percentage he found was 4%.
There we go. All right, Nick. Well, I appreciate you coming on. I know there's so much more that people can learn from you. And so I want to encourage everyone to check out your blog, your writing, your work. What's the best URL, the best place for them to go to access that?
My blog's at ofdollarsandData.com. You can also reach out to me on Twitter at dollarsandData, or on Instagram at Nick Maggiulli, or LinkedIn Nick Maggiulli. And I answer every DM. So feel free to send me a DM if you want me to dig into something, or I probably have written a blog post about it I can send you. But truly appreciate your time, and thank you so much for having me on.